A common dilemma that many traders face, including beginners, is which price to use when drawing a trend line. Is closing price the most important, or open, or high, or low price? Of course, for the close price advocates, I have to confess that Charles Dow himself preferred the close price. But don't forget that Charles Dow lived in the 19th century, where recording of prices was done manually, and computing and automation was a science fiction back then. Today, current contemporary trading platforms offer all prices, including open, high, low, close, and different time frames. So things are completely different today. Now, let's take a couple of examples so we can draw our own conclusions. Say that prices are moving upwards. We are in an uptrend. So a candlestick opens and then moves lower, much lower, and for some reason it bounces up to close higher. What does it really mean? It means that the price, the low price, found support for some reason, and then the market rejected that low price and moved higher. So which one is the important price here? The open, the high, the low, or the close? For me, since the market found support and bounced higher, I would prefer to use the low price because that price was rejected. Similarly, in a downtrend, prices move lower and lower, but let's examine one specific candlestick that opens and moves higher, and for some specific reason that we don't really care to examine now, this high price is rejected, finds resistance, and it moves lower, let's say much lower, to close there. So which is the important price here? The close or the high? For me, since the high price found resistance, I would prefer to use the high price. Stay tuned for more.
Hi guys, don't forget to subscribe and press the bell to keep up with new videos.